Another day in paradise. I'm reminded of that oft mentioned quote, allegedly attributed to Vladimir Lenin. It's not clear who ever said it, but goes something like, "There are decades when nothing happens, and there are weeks when decades happen." I mean, the pace of developments in markets of late is truly noteworthy, and it's not getting any easier. And I don't think it's going to get any easier. We've got a lot to talk about. Jack, are you there, my friend?
I am. Good morning, Bob.
Hey,
George. Sorry.
so many things to talk about. I guess I don't know where we should go first. Maybe the whole Iran thing. Oil's top of mind. I mean, I was out of pocket the last day or two. So, what's top of mind for you, Jack?
Well, yeah, obviously oil is the big one that's going on. Noteworthy over the last couple of days was the airstrikes on Karg Island in Iran, which is, it's the one point along Iran's coastline where the water is deep enough to get the tankers in and out. And that's always kind of been like the elephant in the room. Anytime military conflict in the Middle East pops up, what's going to happen on Karg Island? Well, on Friday, we struck military targets, the air defenses around the island. The implicit threat is we're either going to bomb the oil infrastructure, which we're obviously reluctant to do, or are we going to seize the island by force, which would involve a rather involved on the ground operation. And I think when trading starts later tonight, we're probably looking at higher oil prices. I don't know if we're looking at anything like we saw last Sunday into Monday, but that's the big question now: is what's going to happen on Karg Island.
So, Jack, again, as the eminent philosopher Yogi Berra once said, I love that quote. Predictions are difficult, especially about the future, and particularly trying to handicap this thing day to day, week to week. I have no idea. Um, I read some really interesting stuff the last few days, which to me was making a more important point, which is I think we're in for a period of sustained uncertainty. I don't see this being resolved um, cleanly and clearly anytime soon. Um, what are your thoughts about that?
Yeah, I think the odds of a clean resolution probably went out the door when this conflict entered its second week. There was the calculus that maybe this would be another Venezuela, that with a decapitation strike, the government in Iran, which was on shaky ground to begin with because of the protests earlier this year, that the Islamic regime may fall and a friendlier regime might take its place. I think we're probably past that point. And the fact that they're now targeting the oil infrastructure, that's a whole different ballgame. So now it's a question of, is the Islamic regime going to survive this and come out even meaner and more aggressive than we went into it? Or is Iran going to turn into something akin to Syria, another failed state? And I think the oil infrastructure will determine that.
Jack,
That
a lot's been written about the they put in what Khomeini's son is the new guy, and candidly, I'm not up to speed, but the little bit that I've read sounds like this is going in the wrong direction. Any thoughts?
well, we replaced one fanatic with another fanatic, and when you kill a fanatic's father, it's doubtful that you make him less fanatical. So, I mean, simple logic would suggest, yeah, we've now got somebody worse in charge there. And but again, without that oil infrastructure, I mean, this is 90% of Iran's oil flows through this island, and Iran is already in the midst of a currency collapse. A lot of people kind of glossed over this, but last fall, the biggest bank in Iran failed, and that's what brought about this currency crisis, which is what brought about the protests earlier this year. And so, economically, Iran has just been absolutely decimated heading into this. Now, if you take Karg off the table, which it looks like if they do try to seize the island, it's about capturing the oil infrastructure intact so that, assuming they are able to accomplish some form of regime change, that oil infrastructure will be available to the incoming regime. I don't know if that's,
Yeah, so
but
yeah. To that point, Jack, sorry to interrupt, but did I read correctly? I think you're implying that in your comments. They have not bombed the oil infrastructure per se. I mean, they're trying to, like, so far anyway, they're avoiding doing that. Is that right?
correct. They bombed air
And
defenses on the island.
And there's also the case, there's talk about Iran now trying to take out other oil assets in other parts of the Middle East. I don't know if they've done that yet, but there's a potential for this tit for tat. Like, they'll start blowing up critical oil infrastructure elsewhere in other countries.
Yeah, I mean that's what they've been doing. I mean, militarily, if you just go by like look on the scoreboard, who's taking more hits, Iran is clearly getting their kicked militarily. Pardon my French, but that has never been the Iranian strategy to match blow for blow with the military conflict. Iran's goal in this conflict is to survive the Islamic regime, to just survive it, and so that means you need to convince the United States to stop. And the way Iran is doing that is not by trying to shoot down our planes, which they can't do, but they can inflict as much harm on as many people in as many different places around the world, such that economic and political pressure causes the United States to back off. So that's always been their strategy. So, who's blown up more stuff? It's obviously been us, but the Iranians do have a strategy here. And it's still way too early to say whose strategy is working better because they're two wildly different approaches and they are both relatively on target at the moment.
Do you ever watch Navy Decoded?
No, I don't.
Oh well, I'd advise you to watch it because this this is an engineering and an industrial attack on Iran, taking out all of their capabilities of building this stuff. And so it is a depletion process. You've put now three carriers in a triangulation, forcing the Iranians to target in three separate areas. It is a wonderful, wonderful YouTube. And I've watched several of these, and it explains it very well and does a much better job than what you're reading from anywhere out there. So I've gone through a number of these videos, and the commentary that you're hearing is woefully inadequate from most of these places. And I strongly suggest watching several hours of Navy Decoded because it does a very good, this is, as they put it, a geometry problem and an engineering problem. And the Iranians cannot find solutions to that. And so, first clearing the skies and then destroying their ability to create new missiles and new weapons puts them in a very serious problem. Once the skies are cleared, then the people can come out and we can use our air power to attack the forces that come to attack the population. This is a strategy which is going to take a little bit of time, but it is a strategy based on an industrial attack on their military capabilities. And the commentary we're hearing from people is actually incredibly bad.
Tina, the name of this series again is Navy
Navy
Decoded.
Decoded.
What is it?
I'll drop you a YouTube link.
Okay. That'd be great. That'd be great. Um, Jack or Tina or anybody else. I mean, I think one of the hopes has been that you would get regime change from within. The people would rise up, but they got the IRGC lunatics and yada yada yada.
Jack,
So,
you do know right now that
Tina, can
no,
I
they're
please
being
finish the
told not to go out yet. You know that, right? So
Can I please finish the question? What is the likelihood that that's actually going to happen? Tina or Jack?
I'll be quick with my answer. One of the things we had hoped is that Kurdish forces in the western part of the country would rise up immediately, and that would make boots on the ground unnecessary. The Kurds so far have not done that. They're reluctant to do it because, look, the imagery of people falling from the landing gear at Kabul airport is still fresh in people's minds. That wasn't that long ago. And historically, when the US says rise up and people rise up, we tend to leave shortly after that. So there has been a hesitancy for any forces in Iran to materialize, at least thus far. That doesn't mean it'll never happen, but it hasn't happened yet.
the U.S. has been saying right now
Tina?
to stay in place and not do anything, not go out, because they're not ready to provide the support they need. That's what they've been telling people.
Yeah. So, with that in mind, it would seem that the most likely scenario is there's no resolution for the time being. And how should we put this? I'll put it mildly in institutional speak. That's not conducive to Jack. It's not conducive to PE expansion on equities, if you catch my drift. All right. In the meantime, as the price of oil goes up, oil's still very cheap compared to everything else, so it's not terribly expensive, number one. But as it goes up, it's a huge negative for global liquidity. Michael Howell, please call your office. It's bad for inflation. It's bad for bonds. And will accelerate any potential economic slowdown that we're seeing. So it's bad for the economic cycle, bad for credit. It's just bad, and so it's sort of like someone's just turned up the temperature in the room big time, and I don't think anything good's going to come out of this. I mean, whether you want to short the market, not short the market, whatever, but like, don't come crying to me if you're long and you get blown up here. Because to me, if you wanted to create the uber bearish scenario, this is the way it starts. I'm not saying that we're there, but this is the way it starts. And people I talk to in the energy industry, they said to me, no, we're totally screwed. And so, if you said to me, George, make up a really bearish scenario, what would it look like? This is the opening round of hands of cards that you would need to see. Any thoughts, Jack?
I think you're right to zero in on liquidity. We're tapping into our oil reserves to try to alleviate the stress. Those countries that have it will do that. Those countries that don't have it will tap into other reserves, either financial reserves or try to print their way out of a problem. So they'll be leaning on the bond market. Now, we've seen the 10-year yield is up about 33 basis points since the start of this conflict. And
Uh-huh.
that is also in the midst of the largest treasury buybacks that we've ever done. So the treasury is trying to manage the rise of the 10-year yield right now with some pretty aggressive interventions in markets, and it's still rising anyway. And
Yeah.
ultimately,
And
I think
Jack,
that'll be what if we
yep.
do abandon this plan, I think ultimately it'll be the bond market that forces that move, not necessarily the oil price.
Yeah. And interestingly, um, the Trump administration's been engaging in open mouth operations, talking about cutting rates, this, that, and everything else. Honestly, Jack or Tina, either of you, in this environment, if they were to cut rates, I think it would backfire on them
It's a
spectacularly.
terrible idea to cut rates here. Terrible
Of
idea.
course, of course. So I don't know what you're rooting for if you're bull right here right now. I think you're totally screwed. I really
Well,
do.
how will
Uh,
commodity stocks and energy stocks do in this environment? They're going to go up or down.
well, that's a tough question because if we get a general, it also depends on time horizon. So short run, if it's risk off, anything that's not bolted down goes down, including gold. People sell what they can, not what they have to. Gold's liquid, okay, not to mention a whole bunch of other stuff. So in the short run, it goes down. However, it's because of multiple time horizons, i.e., ultimately coming out of this whole thing, if the thing starts to really wobble, I think you're going to get a big print, you're going to get a big ease. And Jack, will wait your way out on this. And because they're going to have to keep, they got midterms coming, they got the budget's spiraling out of control, you got to finance this whole thing. So they're going to be forced to print. So it may be so you see in situations like this, gold down and then it takes off. So I don't know. I would not sell gold or silver here or related items because I think the upside downside, i.e., maybe gold goes down 5-10% before it goes up 60 or 70%. Maybe silver goes down 10% before it goes up 100%. That's the way I'm thinking about it. So I don't know, Jack, what do you think?
Yeah, I'm in a holding pattern on precious metals. I do, have it's one of my biggest positions, but I'm not buying right now because I do agree with your assessment. In a liquidity crisis, you don't sell what you want to sell, you sell what you can. And so I think gold gets dragged down with everything else if we do end up in a full blown liquidity crisis, which I think is highly likely here. That's not to say the response won't be the same to every liquidity crisis, which is to lower rates and print money. So when that finally does happen, you can expect gold to bounce hard and fast, silver along with it.
Yep.
So I agree with
We're on the same page. We're on the same page. Having said that, you look beyond the gold and silver and the resources, the whole rest of the market just complete me. God almighty. I don't want to say there's literally nothing to buy, but there's nothing to buy. And so, talking rotation for the longest time, it's been a good trade. Yeah, EM's going to take a header. Your favorite value stock's going to take a header. But again, it's about rotation. I think, all that stuff relative to the tech and the AI and all that stuff. I mean, it's a great trade. I mean, let's put it this way: gold goes down, $50 in double jeopardy. Just imagine what the Qs do in that scenario. So, gold versus bonds, gold versus Qs, gold versus everything. It's still a winning trade. So you have to be very careful though about time horizons, and that's one of the problems you have on X, where people, they don't necessarily have the same sort of time horizon in mind. So yeah. So let's move on, Jack. So that's great. Let's go around the horn. So there was oil. I hope Coleman shows up. I put his name in the headlights and I texted him. I don't know if he's gonna make it or not, but why don't we go on to the world of AI? Dan Ives, call your office. So Jack, what's new and groovy in the AI world this week?
I noticed something interesting this week in AI. We had Oracle's earnings midweek, and Oracle had a pretty good. The report was pretty good. You know what you'd expect: year over year, high double digit revenue growth. And Oracle stock initially reacted very favorably to that. It rallied about 10% following that earnings release. Uh, it's given back much of that since. But the interesting thing was that Oracle announced that they were not increasing their capex, and the market reacted favorably to that. And that was my biggest takeaway. Was we saw when all the other hyperscalers reported this season, they all announced big increases in their capex, and all their stocks sold off on that news. Oracle, who has been arguably the biggest joke in the space as far as laying people off, borrowing money, throwing around big numbers to sound good, Oracle blinked, and the market liked it. And I think that's significant. I think the capex cycle is peaking if it hasn't peaked already, and that's not a good omen for this bubble. And
Very well said. Very well said, Jack. Very well said. Because up until I guess the Oracle October announcement, when the stock went 40% on that BS announcement, as Louis Goff keeps pointing out, in a bull market, companies are rewarded for increasing spending, and so it doesn't matter what you think, it doesn't matter what I think. The market will tell you, and the market's been punishing companies the last couple months for spending more money. So I didn't notice this because I've been out of pocket. I had the conference, and thank you, by the way. Nobody Special was fantastic. Replays are available. Now comes the used car salesman out of me. $99. You got it. It's Nobody Special and 14 other guys. Absolutely brilliant. All available on the website. These are longer term investments. Doesn't matter if the conference is on Wednesday and today's Sunday. These are all investments to ideas with a shelf life of, I don't know, 6, 12 months. So, and I doubt that very few people actually watched the whole conference. It was so long. It was, except me. I had to run the thing. It was 7 hours of continuous programming. But Jack, you were fantastic. I can't thank you enough for that. So, if the market, I had not noticed the point you made about Oracle with their capex announcement. That's really interesting to me. Really interesting to me. So yeah.
I want to
Uh,
clarify, they didn't cut it; they just didn't increase it. It's an important detail, but
right, right, right. Um, so anyway, so it'd be interesting to see how other companies behave. Did I see an announcement this week? Nvidia throwing more money at one of the neo clouds.
I did. It's Nebius this time. They it was a $2 billion investment in Nebius stock. Nebius is going to take that $2 billion, turn around, hand it right back to Nvidia in the form of buying their chips. Stop me if you've heard this one. I mean, who needs Crazy Eddie in the Panama Pump when you've got NeoClouds?
Jesus Christ. Jack, how do you? I mean, it's obvious as light of day that this circle jerk is just that, a circle jerk. The people that just are oblivious to this, how do you explain? They just don't understand the math, or they're financially naive. I mean, to me, it's just, I want to keep banging my head against the wall. Make it stop, please. Make it stop. How do you explain all this?
I think half of them are too stupid to realize what's happening, and the other half know what's happening, and they just don't care. They think they can keep it up a little longer. So it's either stupidity or bad ethics. Take your pick. But at this point,
Mhm.
anybody brain
Sure.
can see what they're doing.
Yeah. No, it's complete insanity. Just complete insanity. All right. So anything else on AI world? No, otherwise we go to credit.
One other quick one. Meta announced sweeping layoffs. Did they give us about 20% of the company? So the snake is eating its tail to survive. And they're cutting
Well,
thousands of people to pay for AI infrastructure buildouts. Not to replace them with AI, mind you, just to make room in the payroll to buy more GPUs.
all right, it's unbelievable. Just unbelievable. All right, let's move on to credit. Um, I guess unlike Ben Bernanke describing the housing debacle, the gathering clouds in 2007, I would not use the word contained in describing what's going on with private credit. I think it's a huge deal, and getting away from the Captain Obvious first order thinking, which that's most of the furus on X. I think you really got to think about the consequence. Go to second order thinking. And let me bounce this off you, Jack. Maybe a totally stupid idea, but I'm only doing it in front of 112 of my closest friends. So we know prices are set at the margin. As an example, take housing, which we all understand. Some guy can come into the market and start paying top dollar for everything. Doesn't mean that everyone else will pay that price, but he's setting the price. He's driving prices up. He's aggressive. He's funded with money. Blah blah blah. Okay, so his price is set at the margin. Okay. Um, Flip side, on the way down, someone needs out. He's in distress. Doesn't matter that he's willing to sell at a price lower than you. Price is set at the margin. So with that in mind, and this is totally ridiculous, Jack. Please throw cold water on me because I made this up myself. Just reflecting on all the Captain Obvious source order thinking out there. The price at the margin with a lot of this rubbish, data centers, and I'm lumping in private credit with private equity, but data centers, software, all this stuff. This is the marginal buyer for this crap. And therefore, they're the ones driving price at the margin, again, the price discovery. And so when I see this simplistic analysis, well, it's only 300 billion at Wells Fargo. They've got 59 billion. And as a percentage of their shareholders' equity, it's really not a lot. And oh, by the way, JP Morgan, which is a much bigger bank, has a much lower amount. It's only 20 billion. As a percentage of assets, it's really nothing. So this is a nothing burger. George is fear mongering. No, wrong. This is setting price across the market. I think this is a huge freaking deal. Before I embarrass myself further, Jack, thoughts, comments, reactions?
I agree. Price is set at the margin. And I think what we're watching in private credit is all of these managers are trying to avoid the price being set at the margin. And they're doing that by gating redemptions because their only alternative is to sell assets and find out what those prices at the margin are. And they don't want to do that. And
Correct.
look, they're telling us, oh, don't worry, it's software. It's because AI is so awesome. Well, take BlackRock for example, right? Because right now it appears with a BlackRock private credit loan, you've got a binary outcome. It's either worth par or it's worth zero. Because we've had two instances now where they take a loan and they mark it at par, and then a couple days later they mark it down to zero. Nothing in between. And that was an Amazon aggregator website, and that was a home remodeler called Renovo Homes. I think they do HVAC in residential homes. Neither of those is a software company. So I'm still not buying into this SaaSpocalypse narrative that's being sold as that's why everything's going bad in private credit. Yeah, software loans are selling off, but so are all the other ones. And some of the worst examples are not software names. And for anybody who's counting, my ticker says we've now had 5 of these managers, Blue Owl, Cliffwater, BlackRock, Blackstone, and Morgan Stanley, that have gated redemptions. They've gated at 5 to 7%. Blue Owl gated forever. And the redemption requests have been 15 to 20%. So people aren't getting their money back. They're not selling what they are selling, or when they go and try to sell something, in some cases they're completely 100% written down. So I don't. There's a lot of people, mainly people with assets they're trying to get off their books, that are out there trying to say these are all isolated events. It seems to be an awful lot of isolated events happening lately, and it doesn't look good. And I can tell you what's happening in oil prices is not going to be good for these portfolio companies. That's for sure. If a lot of these companies struggle to pay their bills at $60 oil at 120, they're not going to do any better.
Hey, Jack, this is a guy, bad joke attempt coming, just warning. This is a guy, Baghdad Bob. He wants to come up and speak. Should we let him talk?
I know who you're talking about. It's
No, but seriously, you and I should change our avatars to Baghdad Bob. I mean, it's like, it's watch what they do, not what they say. And this gets to another thing too, which is confidence. I mean, think about this for a second. Okay, price set at the margin, right? Okay, so Jack, work with me on this one. Okay, all right. So let's say they gate people. Use can't leave, right? Okay, fine. So $50 in double jeopardy. where are they going to get the coin or bank or whatever the term is? Where are they going to get the coin to continue to fund the N+1 data center? Like, seems like we may have a power outage here. Like, explain to me how this works. Like, if the inflows stop, doesn't the toilet back up? And I'm sorry for the colorful metaphors. Doesn't the toilet back up and this kind of spills over as it crests over the top of the bowl, as it spills over into financing for data centers and all this AI nonsense?
Yeah, this absolutely does touch the AI bubble. And, we watched NVIDIA pump money into Nebius, and we watched Facebook is now laying people off to try to increase their buys. I think they probably see that the private credit money that has been financing some of these more aggressive data center projects, right? The narrative has been the hyperscalers and their stable cash flows have been paying for this build out. That's only partially true. A lot of it has been financed by private credit. And you're right, it is not reasonable to assume that money is still going to be there a few months from now, not when they're gating withdrawals.
You mentioned Meta, Facebook, laying off 20% of the workforce. That's not normal. I mean, I know we've seen instances where, okay, so Elon Musk fired all of Twitter and Jack Dorsey did something with Block recently, yada, yada, yada. But this is not normal. So what does that mean to you, 20%?
The last time I remember Meta announcing layoffs of this scale was in January of 2022. And you may recall that was not a good year for big tech names the last time they did this.
Right.
And I'm looking at the chart right now. It was in excess of 20%, but I think it was a lot bigger than that. What all the big tech names did.
Okay, so let's hallucinate. I mean, we know the LLMs hallucinate, so we're going to hallucinate. Spitball with me, Jack. We haven't rehearsed this, so let's make fools of ourselves together. So I say, okay, so going back to our markets punished or rewarded. So Facebook announces they want to get rid of 20% of the head count. Let's say the market likes that. Let's say they do. I don't know. Was that announced by the way after the close or during market hours on Friday?
I believe it was after the close Friday.
Okay. So let's say in the ensuing days, Facebook stock price does well, at least relatively well, because the market might take a dirt nap. Who knows, right? So monkey see, monkey do. So I'm leading the witness here. Isn't it true, Mr. Gamble, in your experience of watching these things, that other management teams may be inclined to act similarly? Would that be a reasonable assessment?
Yes, historically, the market has rewarded layoffs, at least over the last few years.
Mr. Gamble, I know you're not an economist, but for all those geniuses out there that profess to analyze every quarterly GDP number, inflation number, and go on about the yield curve, this, that, and everything else, whatever the economic forecast was, at the margin, doesn't this mean whatever it was before, it's now lower or will be lower?
Well, if we're looking at rising unemployment, which the situation in the job market certainly hasn't improved at all, that's not going to help our consumer numbers. It's not going to help our GDP numbers. It's certainly not going to help a housing market, which is also frozen in place. So, yeah, the economist in me is saying that's not good.
And Jack, help me. I'm not too good with numbers. Bad joke coming, of course. I've been reading for months about this alleged housing recovery that we're going to have. How's that working out for the Bulls so far? Can you update me on that, please?
Lennar's operating margins went from 9% to 5% last quarter when they reported Friday morning. So they're selling fewer houses than they sold in 2008 right now. This housing recovery, is it in the room with us now, George?
Hey, Bob. I'm sorry, this is the wise guy. By the way, you and I, what's this Abbott Costello routine that we got here? If anyone else to come up and join in, this is not fair. You guys are making this work. So we got Gnostic in the room, we got Day, we got Real. Come on, guys, get up here. We got to have some fun. You don't want to just listen to Jack and myself bloviate, although maybe Jack, maybe they're laughing at us, not with us. I don't know. So this housing recovery, no, I don't know. Also, I read recently they're putting out an APB for Goldilocks. She hasn't been seen. She's kind of disappeared. Do you know where Goldilocks is? I haven't seen her for a while.
I think she made a soft landing somewhere. I don't know. I hear that's also,
Soft
yeah.
landing.
What happened to
Yeah.
that narrative?
Yeah, soft landing. And oh by the way, this rally and the yield. So Jack, I always get confused, of course, joking. I always get confused between yield going up and price of bond going down. So what you just told me about the change in the yields, that's good for housing, right?
Is that how that works? Higher interest rates is good for housing? Okay.
Jack, if you could moderate for a few minutes, I want to go bang my head against the wall in the garage for a few minutes, if you don't mind. All right, so hold on a second. We got Pasta Joe in the house. Pasta Joe, welcome. What's on your mind, Pasta Joe? Pasta Joe's speechless. Wait.
He's looking.
All right, man.
He's talking.
There
How
he
you
is.
doing, Jack?
Hey Joe. Hey Joe. What's up, man? What's on your mind?
Uh, well, as I like to tell Jack, here's a piece of anecdata. Uh, right now, Lennar is unloading thousands of properties off their um, balance sheet. They've got a 6-month window. I have a friend who's trying to put a deal together for about 2,500 homes and condos, and they're selling at 65 cents on the dollar. He's a BTR bundler, private equity.
Wait, hey, Joe, stop. If I thought I heard you correctly, but like, I want to make sure I heard it correctly, and I want to make sure everyone in the room heard what you said. They're trying to sell 2,500 homes at 65 cents in the
No,
dollar. Is that what you said?
this is one deal. They're trying to unload around 10,000 properties. And these are properties
Yeah,
that are in process of building, which means pads are down, the sticks are up. And what they're
yeah.
trying to do is these were properties that were originally going to be sold to individual buyers. But now what they're looking for is bundlers. There's a guy here in Nashville, a friend of mine, and that's what he does. And he's putting together a deal. And he said he was done buying real estate, but he said that they're putting together these non-recourse loans. It'll be hundreds of millions of dollars, and they're gonna try and take off 2,500 houses on one particular deal, which consists of condos and single-family starter homes, which again, these were houses that Lennar's building for individuals to purchase, and now they're bundling them at at prices down to 65 cents, but definitely between 85 and 65 cents on the dollar. And these are going to go straight into build to rent. These are build to rent bundlers. So what they do is they'll raise money, and then they get money from private equity, and then they bond it out to other, other like retirement funds, BlackRock, people like that will come in, and so there's a mass. They are actively trying to unload thousands of homes off their balance sheet.
And at a price that's less than 100%.
Well, they're already, if you read any of the Lennar, if you read anything about Lennar right now, you'll see that they're already selling at 85 cents on the dollar when you factor in what they call when you close on a house and they give you incentives. Those incentives are how they maintain stasis in the neighborhood. So if they have a neighborhood with 300 houses, they're and they want to lower the price of the house, they don't lower the price of the house because that lowers the comps for the neighborhood. So they raise the amount of you know give backs at the close. So your $500,000 house might get $50,000 worth of incentives. So it's not a $500,000 house; it's a $450,000 house. So they're already at 85%, and that's across all markets in the country. And now they're trying to push stuff off their balance sheet, and they get it into the hands of these guys who do BTR, and they're going to hold that paper for 5 years. Well, maybe not hold.
By the way, is BTR buy to rent? What
Yeah,
is
build to
BTR?
rent.
Okay.
Build to rent is, and Jack and I talk about this a lot. A lot. Build to rent is like the grail for them is to sell to a buyer. If they can't sell to the buyer, then they want to sell to a corporate entity. If they can't do that, then they go to BTR is like the low man on the totem pole, but it's where
Hmm.
you it's where you can go to, like, I guess it's sort of like junk bonds, right? You go to these guys because they'll go and they'll pull money out of different types of private equity. These are commitments, so the check doesn't write until the neighborhood delivers. So they can make commitments, and these are for him, his company. It's everything's no recourse. So he goes in, he sets up the financing. That's primarily what he does. He's a build to rent guy, but he doesn't know a ball peen hammer from a Phillips screwdriver, right? He's basically he's a bundler. So you guys were talking about Lennar, and I just wanted to let you know that that they are actively dumping. Actively dumping.
Joe, Jack. You got anything good to say? Anything positive to say?
I'm positive we're all screwed. Uh,
I mean, can I just go? I mean, we can save a lot of time yet. We could end the show now. I can just go slip my wrist. We'll be done. It'll be a lot. Have a nice day.
Well,
I mean,
so George, the upside is if you're somebody with dry powder and you're not sitting, like these buildings are selling now for, okay, you get a building that was purchased for $200 million and it was sold for $40 million, right? You have a $160 million spread, but it's not a $160 million spread because you have 10, 12 years of inflation, right? So it's not like your money got cheaper. So you're talking about a hundred and whatever that $150 million, but you're talking about $150 million in 2010 dollars, right? You're not talking about 2026 dollars.
right, right, right.
So
Well,
the point is
and
for
let me
guys like my buddy, they have a lot of, they have a lot of dry powder. So, who's the other guy, the friend of George Gammons? He's got a friend who owns a ton of multifamily. These guys, they're buyers. They're out there buying.
Yeah, but Joe, let me interrupt. Let me interrupt. And this is for you, Joe, and also Jack for you. I want you guys. This is a serious point now, Joe. Thank you for bringing this up. It's a really interesting question. So, Jack, you were saying earlier, like no one really interested in price discovery. Blah blah blah. Ha ha ha. Okay. So I think back in past cycles. I'm thinking Japan, like in the '90s. Nobody wanted price discovery. It was because the whole system was bust if you had price discovery, right? And the idea was that, eventually you inflate your way out, you earn your way out, blah, 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 blah. Well, forget about the fact it took 30 years for the Japanese market to regain its highs, but leave that aside. It's not the point. Point is, by now not allowing the market to clear. I mean, the way to make housing affordable again, real simple. Let the market clear. But that would involve, how shall we say, a little bit of wealth destruction for a few folks. And the theys that are in control, they don't want that. So we have this big asset price inflation. Remember the guy Jack and running for whatever mayor of New York, the rent's too damn high. That guy, all right? Like the way you solve the affordability crisis is by letting prices fall. But again, that stands contrary to other wishes or incentives, motivations for other folks. So Jack, seems to me we're stuck between a rock and a hard place. So what say you?
you're right. I don't think they want to let those prices fall, and it's not just about wealth destruction. And that is a big factor, obviously, right? And the common refrain, I get this in the comments, it's because the boomers don't want their houses to go down in value, which is partially true. I mean, I know some boomers who are like that, but most of the boomers I know want their kids and their grandkids to be able to afford a house, even if it means their house goes down. But I think the real reason why they don't want to let housing prices fall is because of consumers. We saw it during the GFC. It's called the wealth effect. When home values go down in value, people spend less at every other store in the market. And
Correct.
it's the stock market doesn't have that effect, crypto doesn't have that effect, but houses do. When people see their home values going down, they feel poor and they spend less, they tighten up. And that consumption drives this economy. If we see consumers pull back more than they already have, and they're already going up to their eyeballs in debt with buy now, pay later and credit cards to try to maintain where they're currently at. If their home values start declining, instant recession. And what Joe is describing here with some of these numbers that he was talking about the, dumping homes at 65 cents on the dollar or 65 to 85 cents. Within Lennar's recent report, you had a 13% decline in revenue and you had their operating margin was almost cut in half. So you can already see these home values are falling, but they're masking it with these perks to try to maintain the comps, to try to avoid that realization coming over the market that these houses aren't worth what they're being advertised at, despite Zillow and Redfin's best efforts. Everybody kind of knows that's the case. That's why nobody's trying to sell and why nobody's trying to buy. When it finally does hit the headlines, that's when it hits consumer spending, and that's when we slide into a recession.
And Jack, just staying with that a little bit. If you then go over the commercial side of things, CRE, where you and I have read all the articles. Everyone in this room's read all the articles over the last year or two. This building's was 500 million, it sells for 50 million. Blah 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 blah. Okay, doing a mark to market, letting the market clear, engaging in a little price discovery on commercial real estate. Like that's how you make things affordable again. But again, that does not serve the interests of a lot of folks who own this crap. So can't the same thing be said for commercial real estate as is the case for housing?
Absolutely, and we saw some examples of that in the last couple of weeks too. There was two headlines that kind of got lost in the private credit malaise of the last few weeks. There are two of these obscure German pension funds. One is for lawyers and another is for dentists. And I forget which one, but one of them took a 50% loss in total assets tied to commercial real estate.
Wow.
And that's the entire fund, not just a 50% loss on one asset. 50% of the fund's assets were wiped out. And then there was another one took like a 60 or 70 billion euro hit from a single asset, single borrower mortgage bond tied to this the Transamerica Pyramid in San Francisco. So these losses are starting to hit in some pretty obscure places. I mean, this has been a pretty wild decade, but I don't think anybody had German dentist pension funds getting wiped out by San Francisco real estate on their 2020s bingo card. But
Jack, did you just make that up? I love the way you roll, man. That's so good. Oh my lord. So Jack, let me ask you this. So you and I are on the same page with the precious metals. We were on the same page, we're on the same page. And I've been the last year been kind of, I've been bearish with the market because liquidity. It's a question of nominal versus real. Called out a lot of shorts, but it's all been rotation. Um, I'm just kind of wondering whether we're inching ever closer to a decline in nominal terms. Forget about real terms. Real terms are screwed. We know that. I mean, housing prices, even if they don't go down in nominal terms, you and I think both believe they will certainly go down in real terms. Housing in real terms is going to be a freaking disaster over the next few years. And that's before we even get into the boomers retiring. We should get to that in a minute, so we'll talk about that. But are we possibly getting closer by the day to the time when we get a proper bear market in nominal terms? I'm not, to me, it's not, I haven't really been forced myself to answer that question because, you've been doing great with the gold and silver. I've been doing great. I had the energy trade, so I didn't really care about the indices. If you want to blow themselves on Nvidia 30 times revenues, have at it, whatever. But you think it's possible we're inching ever closer to a proper generalized decline in the soundbite indices?
yes, I do. I mean, if you look at the S&P, I mean, we know the weightings are way off and that the concentration risk is higher than it's ever been, but most of the Mac 7 are down pretty substantially from their September highs, or we'll say September, October highs. I mean, Nvidia is kind of trading sideways, but all the other ones are down substantially. And, I made this analogy this week. We got another headline in the auto space, and I'll get to the point in a second here. Who was it this week? Was it Nissan? No, Honda took a charge that was equivalent to half their market cap and write down on
What?
Mal
Wait. What?
Yeah,
What?
Honda, it's like a $36 billion company.
The charge was half the market cap?
It
Oh
was
my God.
I think $15.9 billion was the charge they took to malinvest.
Oh my Lord. Oh my Lord.
And look, they're the fourth big automaker to do this. They're all
Wow.
double-digit billion
Wow.
write-downs on bad investments in electric vehicles that they made during the
Right.
Kathy,
Right.
right?
Right. Right.
So
Right. Right. Right.
if that's what the auto market is doing right now, fast forward to maybe 3 years, what is big tech going to look like when they start the
Right.
same thing with data centers? I don't think it's going to be 3 years, but these car builders are getting absolutely destroyed from malinvestment in electric vehicles, which, in my opinion, was several orders of magnitude smaller than what they're doing with data centers.
With you. So Jack, let's go over back to semis in the AI trade. So for all the folks who are looking sort of just a little bit ahead. By the way, do you ride a bike, Jack? You ride a bicycle?
I know how. I haven't done it in a while.
Okay. So I'm a cyclist, and when you're biking, you generally want to look 20, 30 feet ahead at the surface, because if there's a bump or something like this, you can anticipate it, right? So if something's coming up a couple hundred feet ahead, you may not see it because you're looking at the road right in front of you. So when I think of guys who are own Nvidia or Micron or the semis, like, okay, like right here, right now, nothing bad has happened yet because we got the pretend economics, the circle jerk economics, as you colorfully depict. Let's all pretend. I sell you the chips, you pretend to give me the money. Blah 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 blah. The chips go pile up in a warehouse. You were the first one to call it out last fall. Look at the receivables and the inventories. So Nvidia is booking all this stuff as revenues and blah blah blah, and this stuff is collecting dust somewhere. And oh, by the way, there are new chips coming which are faster, and they're not depreciating them quickly enough. And oh, by the way, the Chinese are doing this stuff a lot cheaper. But the analysts, as I call them, not the analysts, the analysts, I say, oh, but look at the quarter. They look at spot prices, and it's my micron earnings estimate is bigger than your micron earnings estimate, and away we go. But it seems to me it's just a ticking time bomb. Time bomb. But the thing is, the market, often does not have an ability to focus on more than one thing at a time. And so the bulls will say, pay no attention to that lunatic, nobody special with his accounting craziness, right? It's like it was a beat. And, maybe if you have a colorful jacket like Dan Ives, you could say, hey, you can be as popular as Dan Ives, right? So those guys, like, I don't know what they're smoking, but I like some of that. Meanwhile, I kind of look at reality, and I see what you see. So I look at semis, and the history would tell you that this is not a good time to be buying semiconductor stocks. Will they blow up tomorrow or a year from now? I don't know, but they're going to blow up. Paying 6 times book for a chip maker is just not a good idea. What do you do with the semis, Jack?
And me personally, I'm short. I'm short the semis. Maybe I'm early, maybe not, but I've watched these Nvidia quarters continue to get better. I mean, they're still posting phenomenal growth numbers. And I have watched the same thing now 3 quarters in a row. The market rallies on the announcement. The AI bros pile into the stock, and then the next day it closes red. And if you've been doing that, then you haven't made any. I mean, you haven't lost.
Yeah.
But
And it is and by Nicoski, if you could please, I see you raise your hand, Dave. Come on in, we could use you. Stan Weinstein, what you just talking about, Jack. Stan Weinstein, it's not the news, but the reaction to the news that counts. The market's telling you it's already in the price.
yeah,
But all the recently minted graduates of the Dunning-Kruger Institute of Finance who have no knowledge of stock market history, this is a concept that's lost upon them. They kind of missed that lesson, if you know what I'm saying.
yeah.
So what do you say? So Jack, what do you say to those folks?
I say use the analogy of a bubble, right? Right before the bubble bursts, you have to blow harder and harder and harder just to maintain its size because it's already sprung a leak. And that's what I see more of these announcements with Nebius, with CoreWeave, with Lambda Labs, increasing the round tripping, even as companies like Oracle start to pull back. We're at the phase where they're blowing as hard as they possibly can, and the bubble is no longer growing. Right? We know what comes next.
All right, stay right there, Jack. So we're going to do Bitcoin Tina for a question, and then Dave Nikoski. Tina, what's on your mind?
Just question: are you shorting individual stocks names, or are you shorting stocks full? How are you? How do you like to short the semis?
Me personally, I bought puts in Nvidia. I'm standing in front of the biggest stock rally in history and betting my life is going to stop. So it's not something I advocate people do, but I've been short Nvidia for a while now.
Great. All right, so let's hold it there. Dave Nikoski, my good friend, it's been a little while. You've been had a hot hand. No victory laps allowed. What do you see going forward?
I see everyone talking about the war and oil, and there's other things that are transpiring in the market that I think have a greater influence, and that's high yield spreads and what you're seeing in HYG, JNK, the BDCs. I think last month calculated that the average BDC was down 36 or 39%. That number is well over 50% now. XLF is at a break into a 5-year relative strength low. Markets tend to follow financials, as we know. Markets don't have a tendency to go up when financials are actually losing ground, right? They can move sideways, and the market can go up. But when they're going down, I'm I'm betting the same way that Nobody Special is. I have shorts in the SOX index. I own SOXS. Had sold it about a week ago and came back into it in the last several days. Names like Analog Devices, looking at China, for instance, just on another tangent, their semi exports are up something like 48%. They're not a
Right.
textile country anymore, and people forget
Right.
that.
Right.
So I think the low end of the range in terms of, like an Analog Devices is down, from what,
Hmm.
360 to 306, down 20%. In
Right.
my opinion, those things are priced for perfection. And
Right.
everyone migrated out of the I names into, the analog chip names. And I just don't think those are going to hold. But I think if we, get high yield spreads to really move out, we're now, as of today, Bank of America High Yield Index doesn't update until well after the close, but I pulled it up this morning as I'm working, and we're at levels that we last saw. I think it was June 8th of last year. We went from the lowest spreads ever in history, and when something reaches a low that low, the move to the upside can be tremendous. I always hear, the market's hitting new highs, and so therefore it can't roll over. Trust me, the market has always hit a new high before it rolled over. The question is, what is the timing of it? And, breadth is deteriorating. We're defensive. I've talked about energy and materials. What's interesting is I'm doing our international product right now of 43 countries globally, done by geographic region, sector and industry. Aluminum overseas was breaking out to 10-year highs in June of last year, whereas our aluminum related names were not, right? And I was a big proponent of the aluminum side, Century, Alcoa, and such and so forth. So I continue to see that we are getting into major supply chain problems. I mentioned on a call that I was in earlier in a space, I just had a friend contact me, and he purchases polymer for medical devices, and the price is up 80 to 100%. And he's ordering it, and most chemical companies, whether it's in Europe or South Korea or Japan, are rolling over hard. The U.S. has access to the chemicals, access to oil, even though it's globally. At least they can stay open because they're the only ones that's going to have it. So I'm very bullish on the chemical companies here in the U.S. Specifically. LyondellBasell is a very good name, but other European names are rolling over and just not having access to it. I think that a lot of the chemical companies here in the U.S. are going to gain considerable market share. That's it from me. So back to you, George.
Thanks so much for that, Dave. Dave, just curious, what do you on energy, the stocks, the commodity, and then also precious metals, the stocks, the commodity? Thoughts? Updated thoughts?
Yeah, I think this war situation, investors are gravitating to the dollar, and the dollar is putting pressure on all foreign markets, which it should. And if the dollar blows out, the safety trade here is owning the dollar. And when you can only do safety for so long, and if our economy starts to roll over with the breakout in high yield spreads, the direction of the equity market is down. It's not up. You got yields blowing out globally. That's something I just don't want to bet against. But I do think that when the smoke clears, and whatever bailout the Fed will have to do, if it has to do one, is going to be positive for gold, for precious metals overall. I don't think the dollar rising is based on the strength of the economy. I think it's based on, I'd rather be here than somewhere that it doesn't have oil. And that's
Uh,
my theory behind that. So I will be a buyer of, Brazil and Australia, when this turns, because I do think that commodities are in a bull market. And I think the advent of AI in October of 22 put energy into a back seat where, what's interesting is if you look at the COVID lows, do you know what's outperforming? Energy is outperforming tech. Most people can't fathom that.
Wait,
right?
whoa. I'm not like quick picture me on that one. Say that again. Say that again.
From the COVID lows, energy is outperforming tech. But you can't get anyone to buy a sector of the economy that's 3.5%. Like I'm sitting there
I know.
going, you're at 40-year lows. And so, that halo, they call it the halo trade now, which is, heavy asset, low obsolescence. And that's what I'm seeing.
The Halo trade. Hey Jack, we got to come up with some new names. I don't know. Hey Jack, can we do like a FAFO trade or something? I don't know. We need some new names here. This Halo trade.
I'll see what
Hey. So, Dave, is it fair to say, I put words in your mouth, but I know you're a bottom up guy like me. You look at rotation, relative strength. What's happening? I won't ask the question in a loaded way. I'll ask the question differently. What's happening to the size, the relative size of the three piles? There's a two hard pile. There's the pile you like as buys. There's the pile that you like as shorts. What's happening to the relative sizes of those three piles, and what does that tell you about the market?
Well, the market is breadth is deteriorating, across the entire spectrum. And it's not that I can't find some decent charts, but most of them are going to be in basic materials and energy. Most of the energy stocks it really haven't rallied even with the price of oil. I'm not a buyer into the energy infrastructure here. I'm waiting for pullbacks in it, and I do think the war ends, we get a shock to the downside in crude. I will be, I've been selling some of my energy names. Not because I don't think they're going higher. It's just that I think they get a pullback to the bases on many of them.
Right. That makes
And
sense.
that's the reentry trade. You don't buy something for fear just because you don't own it. The energy trade started, in my opinion, back in July of last year. We were all over the OIH names. They've done extremely well past market expectations. You take a name like even Century Aluminum. I think on Friday versus Nvidia in the last 6 months, it's up 124% over Nvidia. Like I'll take, as a relative strength guy, like that, unbelievable that you're, with so much attention paid to Nvidia, and you could own something non-Nvidia and get that type of alpha. I mean, that is enormous. So that's how I'm playing the market. When it comes to the top 8, I think when we got into this environment, and many people talked about it for the last several years, it's kind of the Nifty 50 environment. And what you're seeing is that was happening globally. Other markets were skewed much, much higher than the US market in terms of their top weightings. And, so you have kind of a combination, in my opinion, of a Nifty 50 environment, a combination of the 70s and an inflationary stagflation type of environment, coupled with what in the end may be, a 2000 everyone's in tech type of trade. It's interesting when you look at these AI names like Nvidia and how actually poor they're performing versus the memory companies, the optics companies. Like I had this, in our morning show, Gary Cardone's in there, and he had talked to, months ago, and I use this analogy, if you own oceanfront property and you call up someone to cut down a tree, they're going to charge you 4 times as much than if you lived in mile inland, right? And what you're seeing is that all of these component suppliers are extracting unbelievable amounts of capital out of this AI build out, right? Sterling construction is up far greater than Nvidia in the last 5 years, right? Like these companies are saying, you guys got the money, we're going to charge you more. And that's what I see along the whole spectrum. So you're going to push ROI out on these, on a lot of these data centers, in my opinion. kind of along the lines of what Nobody Special says. If you're selling optics, I mean, go look at AAOI, look at Corning. These things are blowing the pants off of any AI. I mean, everyone's going after the companies that have the money, are willing to issue debt. And now we see this continuum of
Right.
we're gonna issue debt to build this out, right? The companies that are sitting back, like an Apple, probably are going to do a lot better buying out some of these AI companies in 4 years when they don't meet ROI projections, and the stock's much lower. And again, I'm not anti AI, just like you wouldn't have been anti-internet, in March of 2000, right? The internet survived, but those that entered the market afterwards did a lot better than where's AOL now? Where's Yahoo? I remember going to conferences and the Yahoo, breakout sessions, in auditoriums in New York were standing room only. You literally could not find a place to stand, and that was Yahoo. When's the last time you heard someone talk about Yahoo? Right? There's emergence of new leadership when you get through these periods, and that's what relative strength will find it. Will I believe it? Well, I'll follow relative strength, and it will point you in the right direction. But getting the bottom tick is not going to happen either. So that's how I look at the market. No one knows who the real winner will be right now. We can
Wow.
speculate, and that's fine. Speculation is good to a degree. So
Yeah. So on your point, Dave, I did a podcast a few weeks ago. I'll fish the graph up. Peter Bear is a bank credit analyst, really sharp guy. He made the observation that from 2000 for the next 25 years, to your point, I think data on the internet compounded like 43% a year, like I don't know, 25,000% or some crazy number like that. Okay. Didn't stop all the internet stocks, the Yahoos and AOLs and Amazons from being unmitigated disasters for quite a number of years before recovering. And then he's got a better chart, which shows the companies that tend to spend the most on CapEx tend to be the worst performers. So, big picture, historical analog would totally support what you're saying. Totally support what you're
yeah, I
saying.
mean, you can look at history. Less than 50% of stocks in the S&P 500 today were in there in 2000. So you're taking a managed index, and really, it would be like me looking at
Sure.
any mutual fund and plotting it. These are all managed indexes. You remember when Erie was added to the S&P 500? It was in end
Yep.
of 24. Go look at the chart of Erie.
Yep.
Carvana. I shorted it. Pre the addition to the S&P 500, made money, and then it got added, and I'm like, hey, it's another time to short it. Like,
Sure. Sure.
how can a
Sure.
company, when you have like Go Easy? Do you know Go Easy? I posted on
No.
my timeline. So it's a
Okay.
Toronto-based subprime lender. It was down 57% one day last week. The next day it was down 18%. Was a $243 stock 5 months ago. Now sitting at somewhere around 40. Took massive charges, subprime and BNPL. Look at Klarna. It's ever since the valuations by private equity and
Sure.
everything was like egregious a year and a half ago,
Sure.
and they had
Sure.
to hold the IPO, and then they came out. I think it went up to close to 50, and now we're sitting at $10. The amount of
Yeah.
retail
And
being fleeced
yes. So
is
all this
incredible.
stuff, Dave, you're talking about, and Jack, I want to go back to you. Dave's touched on private equity and all this other stuff. So you have all these portfolios, laden with this illiquid private equity, private credit stuff marked to myth. And it's like a giant kabuki production. Everyone wants to pretend like it's okay. It's not okay. And I just think that the system's really backing up here. And, whether, maybe in nominal terms, they release the floodgates because it's probably what they're going to have to do, which we then, we got that covered, Jack. We got the gold and the silver. So I still come back to, whether it's gold and silver, let's just keep it simple, gold and silver against Qs.
gold and silver against SPY, RSP against SPY, non-US against US, yada 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 yada. They're all expressions of basically the same trade. Jack, thoughts?
Yeah, I agree. And look, I'd add one other layer to that because I mentioned earlier that I am long gold and silver, but I'm also not currently adding to those positions. The one thing I see people buying consistently is cash. I see the dollar getting stronger, which is not good for gold and silver in the short term. I don't think that's going to last. Um, but I think dry powder is really important here. There are some sectors that were just mentioned. Like I like the idea of U.S. domestic chemical producers. I think that's a good idea. Although if we do see a widespread liquidity crisis, I think good assets are going to get sold off along with those. And
I would agree with that. Yeah, that's the caveat. If we do start to see correlations go to one, um, I agree. And speaking about like the precious metal front, if you look back at history on the relative performance of gold, there's not ever been one period where it only outperformed for 3 years.
Right.
It normally is, anywhere from a 5 to 8 year cycle minimum. So I would agree. I'm not as heavily invested in precious metals right now, but I'm looking for that turn where if there's some type of bailout in terms of private credit, I think that you'll get a big upward move in the precious metals coupled with a decline in the US dollar.
Yeah, we've been saying that multiple times before you came in the room. Um, I guess the point I really want to make, I'm listening to all this, I'm agreeing with everything you guys are saying. We're all on the same page. We're going through a regime change, in my humble opinion. Active managers are getting their heads handed to them by the benchmark indices. And, David, your job is to help active managers. And we all know that if you didn't own Mag 7, you didn't own tech, you had no shot. We're starting to see now this year that Mag 7 ain't where it's at, Tech's ain't where it's at. And the thing is, this trade went on for so long. Just because we had a few months of reversal of performance doesn't mean anything. I think this is going to go for years. I think probably a better comment to make is I think this is a year that it's going to be really easy for active managers to outperform the index. It's absolutely perfect because you got everyone crowded. Oh, I got my index funds and I own bonds, I own bonds. And I got my index fund. Well, why don't you? And then I love when they say, why don't you sell? Do something really simple because of Dave and Jack. I know you believe this. Well, for starters, if you don't want to sell your equities, why don't you just go from S&P, SPY to RSP? Oh, well, I have to pay taxes. Or if you tell them to sell their equities, oh, then I got to figure out when to get back in. And oh, I got my fixed income, my bonds. Oh, you mean those pieces of crap that have gone nowhere for 4 years? Why don't you just take your bonds, sell it all, and buy gold and oil instead? I mean, everyone is just so out of position that I really think this is, I don't want to say it's a golden age of active managers. I mean, who the hell knows? But right here, right now, it's been easy so far to beat the market this year. I think it's going to continue to be easy to beat the market. Tina, you got a question?
Yeah, it's a question for you, George. If we go into recession, you don't think you're going to want to own the 30-year? I
Uh,
don't mean you're going to own it by the time they start really trying to liquefy, but before that time, you don't think you're going to want to own the
no,
long end?
because no, I'll tell you why. Because I'm going to argue strenuously. Yeah, you're if you want to measure the 30-year in American pesos, you're correct. But if you want to measure it in real terms, again, JP Morgan, please call your office. Gold is money, all the rest is credit. Bonds have been an unmitigated disaster measured in gold. The only way, I'll get to you 1 second, Jack. So measured in American pesos, yeah, bonds may go up. But then you think Bitcoin, Tina, the implications of that, what it means probably for the rest of your portfolio, and how the equity is going to get absolutely obliterated. So to me, it just doesn't hold water. Jack, please weigh in here.
yeah, I just want to say, look, we've got inflation's probably going to be heading higher here in the short term. Unemployment probably going to be heading higher. Housing market frozen. An oil embargo in the Middle East. I mean, the 70s are back. and long duration treasury debt is the worst place you could be in that environment. The worst place.
No, I only mean it as a trade in a recession, and I don't remember how you did have bond rallies in the '70s. Now they broke down, so I don't disagree with you on the longer run. But in terms of a trade, maybe it's a you know five
I
month
mean,
trade.
Bitcoin. Yeah, let's put it this way. You may be right, but it doesn't float my boat. It's not floating Jack's boat. Okay. I mean, you could be right, but what also could be the case, you could say, well, look what happened in the past. We got a recession, this, that, right? And then you could also be wrong because as Jack's pointing out, they're going to print more money. Price of oil right here, right now is going up. If they see pretty more money in the short end of, and they try to push short rates down, I think it's going to have a huge, all things being equal, which they're not, it's going to be a huge negative impact for bond prices. So I'm not, I color me unconvinced. You don't want to short bonds, fine, but I would not own bonds. I really wouldn't. I think your margin of safety is just, it may work. It's a bad trade though. It's like you're like, okay, so Bitcoin Tina, you're gonna put it up from 35 feet from downtown behind the 3 point line. Yeah, I might go in, go ahead, go for it. Doesn't mean it was the right trade. So I just like it's not right now. Bonds right now are dead to me. They're just not interesting because we state all the reasons why they could suck and the conditions under which they're gonna work is going to render that a completely inferior trade. In a world where your bonds work, Bitcoin Tina, gold's going to be at 8,000. So that's why it's a shitty trade. It's an inferior trade. It's dominated by precious metals.
Well, I don't disagree with you, but I remember in the GFC
I
because
don't, the Tina, no, stop. You're invoking GFC. It's totally different. Don't do that. It's similar, but it's different. You're stuck on that. You're stuck on that construct. Don't cite how it's the same. That's going to lead you and every other person astray. You got to think how it's different. That's the mistake you're making.
that's why I asked the question, George.
Well, that's why you don't stop bringing it up. I told you why it's not going to work. Gold is going to dominate in a world where your bonds work. Sorry to get hot, but I keep getting this from people. In a world where your bonds work and they may work in nominal terms, you can't own enough gold. You can't own enough silver. In other words, what they're going to have to do to make the bond prices go up and yields go down is flood the system with so much freaking liquidity. Maybe even Bitcoin will go up. I don't know. But this is why you want the uber bull scenario for gold and silver and the miners. It's exactly this. Exactly this. So why would I fuck around with bonds when I could have gold miners tripling from here? That's what you're asking me to do. It's the wrong question. I hope I made myself clear. I love you, man. Let's go to Smatta Mama Nix. Smatta Mama Nix. Are you in? I'm trying to get you in here. Oh, here, get up here. I haven't heard from you. I haven't heard your dulcet tones recently. Oh, here, get in here. I have to speak. I got laryngitis.
Member to this conversation.
What's your question, please?
What do you think about the virtual machine and its implications on how trading can happen on Bitcoin and off?
Okay, we just got rid of her. We don't need that.
I feel like the
We're gonna
guy in Jaws when he says tiger shark. I just said, "A what?"
Yeah, exactly. All right, Crispy or Shrispy, what's on your mind?
How's it going? I was just wanted to ask David a little bit about his position on analog devices. He was saying he's not too optimistic about these smaller foundries and semi players. And I was just wondering about the perspective when we're talking about defensive spending and like national defense authorization, like barring Chinese inputs. And I've
All right,
seen a lot of
hold on. Oh, Crispy, hold on. You're getting deep in on narrative. That's not the way Nicoski rolls. I like Nicoski. I like what he does. He's like, you go to the doctor, he takes the vitals first. He looks at the numbers. You want to then tell a story around the numbers, that's fine. But before we get into the narrative and your fundamentals, and I like to joke, fundamental things happen for technical reasons, not technical reasons happen for fundamental reasons. So, Dave Nicoski, what does the chart look like to you? Forget about the story. Dave Nicoski, what does the chart look like to you?
I mean, it had a like a blow off. I mean, it just it went too far too fast. It reminds me of Deere beating by 5 cents and going up $70, and you're sitting at like, a ridiculous. And I'm not a valuation guy, but I when Oracle reported and went to 345, I shorted the shit out of it. Right?
Right.
Where is
Right.
Oracle now? Like I know what fear looks like. That was being bought on fear, and so is Analog Devices. It doesn't mean it's. Remember, you can be a great company at the wrong price. That's where I see ADI. And I see the potential for high yield spreads to blow out. It won't matter what you own. That's where I'm at. And I
Yeah, I'm
think the
more.
egregious price moves as people liquidated their AI. Look at Nvidia versus AI. Nvidia has probably got 100 times better fundamentals if they're correct. But everyone and their grandmother ran into ADI. I just don't see that. That's a chart pattern where I look back historically and see the RSI like peg 99. That's not a buy to me. That's a run.
I mean, Dave, I look at here. We broke through the 50-day, the 200 days down at 260. So we can revisit the conversation, revisit the item at 260. Is that fair?
Yeah. Agree.
And there's so much stuff like that. Like Dave, SanDisk, do me SanDisk. What do you say on SanDisk?
If I
I'm
could, I wanted to talk about the broader semiconductor industry with analog sensors in particular, not
No, no, no,
specifically
no, 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 no,
ADI.
no, 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 no,
But
no.
you're moving to memory, you're moving
No,
to the
no,
other
stop. I'm gonna throw you. I'm
semiconductors.
gonna throw you out. No, no. We can talk about the charts. That's what we're gonna talk about. We're not gonna
Okay,
talk about the
look at the
fundamentals.
TE connectivity,
You
chart
want to talk
10L.
fundamentals? We're not gonna talk fundamentals because you're in narrative. We're talking charts right now.
Okay, but the robotics industry is not going to be dependent upon China, and that's my piece. Bye.
Yeah, goodbye. We want to make this a narrative-free zone. I mean, it's just people come in with this nonsense. It just makes me crazy. Liz Ann Saunders. Oh, hello, my lucky day. And we're gonna go to Kane, and then we'll go to Liz Ann Saunders. Kane,
Hey,
my friend.
Joe.
Kane,
Hey, how are you, my friend?
good,
Just
good.
back.
Kane, what's up? What's up?
David, I wanted to know what your thoughts here. I'm looking at Latin America. It's trading at about 10 and a half times earnings. Europe is trading at about 14.6. And I'm seeing banks are now trading at around 12, and staples are trading at record highs. And utilities are near 4-year highs versus the gold miners. So I wanted to know what your thoughts on those sectors are and what the charts are telling. And other than that, I'm just back from vacation.
Yeah. Great to
I
have you
needed a.
here, buddy.
Thanks, guys.
Kane is a good friend of mine, by the way. Formerly worked with Art Cashin for many years on the exchange floor. But besides that, I'm less invested in foreign markets right now. And it doesn't mean I don't like them. It's the dollar strength, and we could eclipse that 166 level. Um, and again, this is based on fear, in my opinion, as the U.S. is the safest place in the world in terms of the war structure. And I think the foreign markets like Japan, South Korea are going to have some significant problems. I'm seeing supply chain problems uh, as I've started in this conversation that are going to mimic, so not exactly, but mimic some of the COVID type problems that we had on supply chain. So until the dollar reverses, I do believe that Brazil will be the first place I buy, simply because of the commodity structure, and I do believe commodities are entering into a secular bull market. You look at the time horizon of gold and silver starting to outperform, and then all of a sudden oil was moving long before the war started taking out in terms of their equity pricing. Was moving up. The OIH is up significantly against the S&P. The other thing that, George, you talked about earlier about the passive investing and active managers, it's funny that you have these deviations between the sectors in the S&P that are enormous, right? If passive investing was going into the S&P, you had chemicals, transports, paper stocks absolutely getting rugged in the last year. They all made a bottom in November, and those areas are far outperforming the market. And that's coupled with that altcoin sell-off in October. So you are having money coming back into old economy stocks that were literally, five-year and 10-year and 20-year relative strength lows. So I agree with you on the active manager spot, but it's amazing that even some of these names are in the S&P 500 and just got liquidated, up until November. Like enormous, differential between the returns of the S&P and,
Yeah,
you take a
yeah,
DuPont or a Dow.
What about when the boomers have to start doing their RMDs that have their money in the S&P 500? You're talking about trillions of dollars that have to be forced liquidated, and they're going to be selling to because they have to pay the taxes at 73 years old. And what's the median boomer age? The oldest
yeah,
one
so,
is
yeah. So, Kane, hold it. We're going down a rabbit hole here. I don't want to go down this rabbit hole. If the passive bid becomes a passive offer, Katie bar the door. We all know what that's going to look like. So, I don't think that's worth discussing because it's lights on, lights off. And if this gets bad enough, as we all know, flows follow performance. That's the way it always runs. It always works that way. So right now, the indices, the soundbite indices, have not done anything wrong, so to speak. It's a massive rotation, and so all the guys who own tech and software and all that stuff look at their navels, saying this is unfair. I'm getting destroyed, but the market's only down 3%, or whatever. It's only down from the peak, but it's a market of stocks. It always has been, always will be. And so, once the soundbite indices break down, and they may not. I mean, who knows? We're gonna, Trump worships the ultimate of the stock market. Who knows what they're gonna do in pumping more liquidity? And Michael Howell. I'll just run further afield. Michael Howell, who everyone knows, everyone's friend, been more right than anybody on markets. He's sounding the alarm on liquidity. And so I think you got a real problem here. And you don't need Cargill to blow up and the world to come to an end to be bearish on stocks. It could just be a liquidity drain. I mean, I think that's what you were saying earlier, Jack. We were talking about. So I'd say be afraid, be very afraid. Just hold it right there. I want to go to O'Hare. O'Hare, how you doing, man? What's up? You there? O'Hoddle, unmute yourself.
Yeah, what's going on, guys?
So you've been listening? What's your reaction to everything you've
Well, I
heard?
hopped in a little late. I was actually out at the gym, so I probably missed
All
a
right.
bunch of
All right.
your stuff.
O'Hoddle, I'm going to make it real easy for you. I don't want you to start from square one because you've missed an hour and a half. You've been in for 20, 30 minutes. I'd like you to react to anything that you've heard here.
Well, I mean, I agree with a lot of what's been said. I think this is something we've talked about for a long time. I think yields are going to probably stay higher for longer. It's really hard for I think for long bonds to come down in yield given the environment, and I think precious metals are going to continue to do well. Notwithstanding the last few weeks. I mean, everybody expects all the guys that started getting into gold and silver late last year, early this year, while it was going parabolic, which is why it was going parabolic, right? Prices go parabolic because everybody's jumping in. They expected the move to keep going. And of course, things don't just go up forever. You're going to have a relief valve. And I think that's what we've seen. Gold and silver still up for the year. They've outperformed everything else. And I think that'll continue into the end of the year. So as far as price targets, I have no idea. I think higher for sure. How much higher? I have no idea. I think it could be considerably higher from here. I think gold could move 30% from here by the end of this year very easily.
Yep.
So, and silver too. Silver, I mean, that's anyone's guess. I
Hundred
mean, that
percent,
price is
100%.
wildly
So
coyote.
here we're on the same page on that one. Energy. What do you think? What do you think energy rest of the year? You have you on energy stocks? Here.
Energy, yeah, we love energy. We've been talking energy for a long time. I think we like us particularly. We like the kind of midstream, downstream guys,
Yep.
refiners for sure. Refiners are a great place to be right now. And I think I chemical stocks, anything to do with David and I talked about this a few weeks ago. We touched on Dow Chemical and DuPont and some others, and these are areas that have
Yo,
of high interest.
here. What's the 30-second elevator pitch on, or the driver on the chemical stocks? Why are they buys now?
Well, I mean, shit, it's not 30 seconds, but there's just been a lot of consolidation in the space. There's just not that many guys operating in the space. I think their margins have been improving, and I think that these things have just not been working for a very long time. So I think you couple the fact that there aren't that many competitors in the space, along with improved pricing
Mhm.
pressures. I think you're going to see increased revenues and earnings for these guys over the next couple of years. but we can't live without these things. So
Okay.
the fact of the matter is,
Okay.
even if the economy slows a little bit,
Yep.
um, I think they'll do quite well.
Here in a sector you've trafficked in the past. I don't know if you're there or not, but I know it's a sector you know. What's your take on the fertilizers here?
Wow, now you touched my one of our the fertilizers are our best performers this year. We own we have a pretty good slug in three different fertilizer names that we've owned
Victory
for a
laps
while now.
not no O'Hare. Victory laps not allowed.
Oh,
We're talking about
oh.
looking forward. Okay, now and the end of the year. What do we do with fertilizers?
Well, we're buying more. Let's put it that way. We like these names. We like fertilizer. Anything to do with fertilizer, potash,
And is
urea.
this how's this played to the energy situation? Why
By the
are
way, this wasn't anything to do with Iran. We like
I
these
know, I
names
know, I know. So
for a
tell
long
us
time.
what was the reason for buying them before Iran? That's what I want to know.
Well, it was mostly fundamentals.
Yeah, but
These
What about the fundamentals? What about the
Well,
fundamentals?
again, going back, there's been a lot of consolidation in this industry for the better part of the last couple of decades. You've had improved margins for a lot of these guys. You have a more of a global customer base, and you have supply constraints. So you couple all that together, and you can see some improvement on the top and bottom line for these guys.
Right.
So I think that the businesses are running a lot better these days than they were, say, 3 4 years ago. I mean, they certainly, they had that big boom after the war in Ukraine
Yeah.
started, and then they
Yeah.
just faded. And so I
Yeah.
we like fertilizers going into this year for sure.
Yeah. Here, it may have been before you came in the room, but just curious. I made the proclamation that certainly this is a year for active managers. I think depending on the fate of the tech trade, which I think is going to go the wrong way, I think we could be in for a sustained period of outperformance for active managers, especially if the passive bid starts to go the other way. So if you had to handicap it, I mean, I'm not talking about your book. I don't want to hear about you. I'm just talking generally. Do you think this potential outperformance for active managers could have a ways to run, could be a multi-year run, or how do you think about that?
Well, I hope so. I mean, that's what we do, right? I hope it can be a multi-year run. There are fewer and fewer active managers these days. We're kind of a dying breed. We're kind of dinosaurs. Everybody's ETFs, everybody's thematic, as you know. We had the guy Crispy come up talking about, drones and things, and there are a lot of people specializing in different niches and themes and things like that. But as far as active, fundamentally based managers, there are just fewer and fewer of them. So I think I think it's going to be a really interesting next few years. It's already, by the way, last year was our best year, and we're an active manager that's concentrated in less than 30 names that represent 10 gig sectors. So we're well diversified among the gig sectors, but we're stock pickers, and I think that's gonna continue. One thing you guys touched on. The market's only down just a few percent off the highs, and yet some of these large mega cap names, the mag sevens, are down anywhere from 10 to 15, 20% or more. And I think that will continue. Remember, there's just a tremendous amount of money in these names. I mean, trillions and trillions and trillions of dollars. That's going to take time to correct itself. That'll
Yep.
take years. It's not
Yep.
going to happen over the course of a
Oh
quarter or two.
here, oh here, you the man. We on the same page. I love you. I love you, dude. All right, listen. Any other question? All right, so I'm going to shill one more time.
David's got his hand up here.
We'll get David. Hold on. We'll go over one more time. I'm asking all yous to buy the replay. I'm telling you, this conference was on fire. Okay, we had 15 guys. Some of the ideas, I'll just give you one. I'm not gonna tell you the name of the company. All right, but you gotta. Okay. So Alberto Alvarez, the guy who gave all the platinum stocks last year, which went up anywhere from 1x to 5x. He gave Sprott. He did all the silver miners last fall. Great young guy out of Europe. He's underexposed. He came up with a nut stock, an almond stock. It's a great idea. Basically, what's happening is almond supplies are threatened. California is the biggest manufacturer of almonds in the world, and as you know, O'Hare, there's in California they put in new restrictions about water consumption. They rip up the almond trees and blah 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 blah. So California production is going down. Spain, they've had fires. So two of the biggest producers in the world supply is going down. Meanwhile, demand for almonds keeps going up. This is kind of one of these, and it's just a crazy story. He's a complete nut job. This is a nutty. He entitled it's a nutty thesis. So supply down, demand up. It's going to be like one of these cocoa coffee type plays. I don't know what the stock's going to do. I have
I'm
no
actually
idea.
very familiar with the almond industry,
Oh,
actually,
yeah,
and
hold on. No, here.
yeah,
This is time. Please hold it. Hold it.
yeah,
This is
go
time,
ahead.
right? Point is, This thing is, there's been no, the stock is dead in the water the last few years. The chart looks great. It's one of these things like shipping stocks where like all the prices are going to flow through to the bottom line. I mean, look, it's hard to say, but could this thing do a Coco and go up 5x? Yeah, it could. Is the risk reward phenomenal because the chart's done nothing and it's on its ass and it's cheap? Oh my God. I mean, I was like, it's a stock. I'm not going to mention the name here. You gotta buy the replay. All right. You know, Pete, you get what you pay for. You don't get what you don't pay for. Okay. We had Robert Mullen in. All right, talking about some of the energy names. Oh my freaking God. I mean, dude, O'Hare, he's in your hood. He's up over 100% last year. He was up already 35% this year. All right. Like the dude knows of what he speaks. We had uh we had Tommy Costa in. Oh, check this one out. All right, I'll give you one name just to give a taste, a tease. But come on, guys, $99. This is ridiculous. Like I do these spaces for free. We raised $250,000 for World Central Kitchen. You know, the reason I'm not giving you this stuff is like gotta be real about this stuff. I'm doing you one, you do me one, right? By the way, we had 800 people, 800 people at this conference. 800. It's better than any conference you'll ever go to. Why? Because we had the best speakers. And guess what? I didn't pick a stock. You didn't have to listen to me. It was all these other smart guys. Thank God you didn't have to listen to me. All right. So it was absolutely phenomenal. So I started to mention Tom Chanos. I'll just give you his one. All right. He recommended Fresh Pet last year. This is what's so great about this market. It's a gift that keeps on giving. He recommended, it's the only name I'm going to give away. He recommended Fresh Pet last year. Stock was down like 30%, blah, blah, blah. Okay, fine. He covered it in the 40s. Lo and behold, it's all the way back up. I don't know where it is today. It was like 80 the other day. Business is falling apart. There's a new competitor. General Mills has this thing they're competing against them. The stock's rallied. Earnings estimates have been cut for like the third time in a row. It's done 60 times, 60 times falling earnings with a lousy chart and General Mills as a competitor. And oh, by the way, you think as the economy softens, people might cut back on their purchase of refrigerated pet food. And oh, by the way, I didn't know this either. Did you know? I bet you nobody in this room knows this. A human chicken, not human chicken, the rotisserie chicken from Costco that we all buy for the beloved $4.99, whatever it is, that's cheaper than the fresh pet food. This is a gift. Tom has like shorted this thing 4 or 5 times. He's doing it again. It's a great idea. So Tom Chanos, Renaud Soler, Tom Thornton, Adam Parker, Don Durrett on fire, Gordon Johnson. Oh my God, Mullen, we talked about it. Zach Marks. We had Van Drucker, Tommy Costa, Enrique Abeda. Oh, Mr. Talent Energy. He's doing it again. He's doing it again. Enrique Abeda. He's Mr. Talent Energy. He's Mr. 5X and 10X in Talent Energy. He's got another one. We got nobody special on fire. Alberto Alvarez, I mentioned. Motorhead, believe it or not, Motorhead did not talk Tesla. He actually had a long idea. And then Jay Pulaski, masterful keynote speech tying it all together. Listen, you guys do what you want. You do you. I'm going to do me. I'm telling you, this is the best conference you will have ever gone to or bought replays for. And if you don't like it, I will give you a refund. I guarantee it. If you want the refund, you just got to tell me what it is you didn't like. It's got to be legitimate reason. You got 15 guys, 15 ideas, $99. Who gives a shit? The conference is Wednesday and today's Sunday. These ideas are like for the next year. It doesn't matter. This is the best conference ever. And by the way, it was so successful. I made this announcement the other day. We're doing more. We're doing another stock picking conference in June. We're going to do the stock picking quarterly, and then we're going to do one in May. I haven't made up my mind yet whether it's going to be an income conference or technicians, but you're going to be seeing a lot. There's a market for this. You want to democratize finance? You come to the right place. None of these blowhard furu jerk offs on X. You want ideas from real people? Guys up 100%. Guys selling $40,000 research products. No narrative nonsense. This is the place for you. All right, who had their hand up before I go? Because I'm losing my voice, as you guys can hear. Nobody special. Dave, O'Hare, anything last thing you guys want to say? I guess not. Regular Joe, I'm tired. My voice is failing me. We'll get to you next time.
I
So
have some comments on the fertilizer space that
yeah, Dave.
I
Yeah,
like.
yeah.
I love the fertilizers, but you're going to have soft grain commodity prices rise substantially for the price that we're seeing. I think farmers are going to commit less if if these prices stay intact for the next 6 months. I do think that they'll get a pullback in the prices of urea and everything as the straits open up. But my view is we're stuck in the stagflation cycle. I highlighted the chart of wheat probably a month ago, breaking that downtrend. These things have been eviscerated in the market for the last several years. I'm a buyer, and I think that you want to own the soft grains, and coupled with the fertilizers, I
So,
think you could get.
Dave, in the soft grains, you just buy an ETF, or what are the tickers you got to buy in the soft grains?
Well, there's you have I think it's the Moo. You can play WEAT. You can play SOYB. You can play corn. On the soft grain side, there's certainly ETFs out there that has a
Okay,
distributed
that's great
weighting
stuff.
of them. So
Great stuff. Great
that,
stuff. Great
yep,
stuff.
perfect.
All right, guys, I'm dying. By the way, I feel better than I sound, but my voice is just shot. So we're gonna have to end
Get
this.
yourself some chamomile tea or something.
Yeah, chamomile tea and cough drops are all good.
There you go.
Hey, O'Hare, thanks for coming by. You were great. Nicoski, nobody special. Bitcoin team, this is wonderful. Next Sunday, everyone seems to like Sundays at 11. And again, buy the replay. It's better than any other thing you're gonna. It's listen. You can't go out for dinner for $99. If you don't buy this replay, then I can't help you. This is the best of the best. All right, guys, take care. Have a good one. Be well. Bye bye.